in the accounting cycle which is provided, you might have already noted the different sections of an accounting cycle. It starts with a business transaction, then you'll have something called the journal entry, then you'll have something called the ledger entry, then you'll be preparing some kind of account which we normally call it as the trial balance, or it's actually a comparison which will be done. It's called the trial balance, and finally you'll have something called the final account, which includes the profit and loss account. You'll be considering the trading account, profit and loss account, and the balance sheet. The final account is generally considered as a combination, or you'll have three different sections under the final account. You'll have the trading account, you'll have the profit and loss account, and you'll have the balance sheet. So your accounting cycle will have the transaction or business transaction as the first step, journal entry as the second step, ledger entry as the third step, then trial balance as the next step, and you'll have the final accounting, which includes the trading account, profit and loss account, and the balance sheet. Now we will go through what is a journal and how a journal can be prepared. So by definition, a journal is a day book kept in the business wherein the complete history of transaction of accounting nature, including debit and credit aspects, is shown in chronological order. So what are the different steps that you need to follow so as to construct a journal entry? So the first step with respect to the journal entry is, say, you will be considering, or the first column, you will be considering certain columns, or you will be entering the data with respect to certain columns based on the given question. So the first step is you need to write the date of transaction in the first column, which is basically called as the date column. So what is a journal entry? You are considering, say, day by day transaction with respect to a firm or with respect to a enterprise or whatever it be. You are considering the day by day transaction, and all these transactions are actually recorded in a book, and this is actually called as the journal. Now, how you are representing this? You are considering certain steps, and the first step is the column in which you are entering the date. So you will be entering each transaction on a date basis, and the date corresponding to each transaction will be recorded in the first column. The second column, you will be writing the names of the account to be debited and credited. We have already gone through different classes of accounts, which includes the personal account, real account, your nominal account, and apart from that, you are having the modern classifications also, your asset account, your liability accounts, all those classifications. So we will identify the names of the accounts to be debited and credited, and in the second column you will be writing the account to be debited and credited, and among the accounts that to be credited or to be debited, you will be writing the account to be debited as the first one. Then in the same column, you need to write a brief description of the transaction. What exactly that transaction is meant. Say you are giving something, some product is actually sold on credit basis. So if you will be writing it as this product is sold on credit basis to this particular firm. So in a similar way, you need to write the names of the accounts as the first part in the second column, and that too the debit account first. Then you will be giving a brief description of the transaction in the column within brackets. That completes the second column. Now you can expect a third column which you will not be filling as of now, which means that will be done at a later stage where you are having what is called the ledger account that is formed. So there is a column which is specifically called as or represented as LF, which represents the ledger folio. So once you enter all this data into the next class of accounts, which is called the ledger accounts, you will be identifying the number or the page number with respect to that ledger that will be represented in this. Only then the corresponding journal entry will be completed. So for the time being, you can forget about the LF column. So just keep it as blank. And the last column, last two columns, you will be considering as for the debit aspect, amount is debited or entered on the debit amount column, and for the credit aspect on the credit amount column. So you will have total of 5 columns. First one represents the date or entry of date, or it is called the date column, and second column represents the names of the account that you need to consider for debiting and crediting, and below that you'll be writing or you'll be providing a brief description of the transaction, the type of transaction. Then the next column is called the, or it is written as LF, which is the represented as the ledger folio. For the time being, you can keep it as blank. Then the last two columns represents the debit side and the credit side. So the amount that is entered on the debit amount, or will be a debit aspect, the amount is entered on the debit amount column, and for the credit aspect, we will be entering the credit amount on the credit amount column. Now we can, or we will explain this based on a particular problem so as to prepare a journal transaction or journal entry with respect to the given transactions. So just consider a question which is analyze and record the journal entries related to the transaction in the books of Ajay. So you are considering the accounts of Ajay, or you are considering the firm as Ajay, and you need to enter the day by day transaction of Ajay into a journal entry. So the question is, say the month is given as 2004 August. The dates are given as 1, 2, 4, 7, 14, 19, 17, 19, etc. So on August 1st, Ajay started business with cash rupees 25,000. On August 2nd, he bought furniture for rupees 2,100. On August 4th, he purchased goods from Anand Traders for 2,850 rupees. Then on 7th, cash sales rupees 3,500. On 14th, goods sold on credit to Manohar rupees 2,500. On 17th, paid for office stationery rupees 25. On 19th, Manohar remitted rupees 1,000 on account. Then on 21st, interest on investment received rupees 150. On 25th, paid rent to landlord rupees 550. On 29th, Ajay has withdrawn cash rupees 500 for his personal use. And on August 13th, he paid salary to manager for the month of August, which is rupees 1,000. So these are the transactions with respect to Ajay's account or Ajay's firm that is provided. You need to convert this into a journal entry. So as I said, you'll have basically 5 columns. First column represents the date. Second column represents the particulars, which account you are entering, which the debit account and the credit account you need to represent. The third column represents the ledger folio. For the time being, you can keep it as blank. Then the fourth column represents the debit amount, and the fifth column represents the credit amount. So we will consider all these transactions one by one and how we can represent this in the journal. So to take the first case, so what it is mentioned, Ajay started business with cash. So Ajay started business with cash means you can consider cash account is actually the debit side, and what you have Ajay have is actually the capital, or he is starting business with a amount of rupees 25,000, which is converted into capital. So here this cash account is the debit side, and Ajay's capital we can consider it as the credit side. Now in the bracket, as I said, you need to represent the corresponding transaction which represents the amount invested in business. So this 25,000 is the amount invested in business, and the debit side transaction is spending an amount of, say, is using an amount of say 25,000. So that is the amount that is debited. That amount is actually utilized for the business. So it has got converted into Ajay's capital. So Ajay's capital account, it is on the credit side, which is 25,000, and cash account, which is on the debit side, which is 25,000. Now next is he bought furniture for rupees 2,100. So this furniture is actually an asset, and he has bought furniture for rupees 2,100. So you need to remember the rule that we wrote for the real account. So whatever comes in, that you need to, or debit whatever comes in and credit whatever goes out. So furniture, he is buying a furniture for rupees 2,100. So furniture is whatever comes in, so that you need to represent in the debit side. So it is 2,100, and what goes out is actually the cash. So cash account 2,100 you can write here, the credit side. So In the bracket, you can give a brief explanation, which is furniture purchased for cash. Now the next transaction is purchase goods from Anand Traders. Purchase goods from Anand Traders for 2,850. So purchase goods is whatever comes in. Purchase goods is whatever comes in, and here it is not mentioned cash. Only where cash is mentioned, you need to represent that as the cash account. If cash is not mentioned, we can represent it as purchase on credit. So here purchase account is the debit side, so it is 2850, and Anand Traders account is the credit side, and the purchase goods on credit is the description. So it is on the credit side, 2,850. Now on 7th, there is cash sales. So you are selling some goods and you are getting cash. So whatever comes in, that needs to be represented on the debit side. What goes out is actually represented on the credit side. So here you have cash is the amount that comes upon selling certain goods. So this cash is represented on the debit side, and the sales account. You are selling some goods, so sales account you need to represent on the credit side. So the description you can provide as the goods that are sold for cash. As per the transaction as on August 7, it is cash sales that we have discussed in the previous case. So the cash account, it is the debiting side, and sales account, because you are selling certain goods. So whatever goes out should be credited, and whatever comes in should be debited. So cash account, you are representing it on the debit side, and sales account you are representing on the credit side. So sold goods for cash. So since it is represented as the goods are sold for cash, you can represent it as the cash account. So if it was the goods that are sold for credit, you cannot represent it as the cash transaction. So it will be a credit transaction. Here it is specifically mentioned that the goods are sold for cash. So you can write the account as cash account and the sales account as the credit side account. Now the next is on August 14th, sold goods on credit to Manohar. Sold goods on credit to Manohar. So you can consider you are selling some goods to Manohar, which means yeah, something that goes out from the firm, which is sales. You can represent it as say 2,500, and Manohar's account you can write it on the debit side, and the transaction is, it is not the cash transaction, it is a sales on credit basis. So on 14th August, you are selling, or the firm is selling certain goods, certain product to Manohar's firm, so that you can represent this as the goods on credit transaction. Now on 17th August, they paid the certain amount for stationery, or paid for office stationery. So this stationery amount or office stationery, you can consider it as an expense. So as per the nominal account rule, we have mentioned whatever the expenses and losses, you can consider expenses and losses, you can represent on the debit side, or debit expenses and losses, credit income and gains. So here this stationery amount that is spent for stationery is actually an expense. So stationery account will be on the debit side. So you have rupees 25 on the debit side, and you are paying it as cash. So cash account, you are giving it in the credit side. So paid for stationery expenses is the explanation for that. Now on 19th, Manohar remitted on account. On 19th, Manohar remitted on account, which means we can write it is an income. So we are considering this cash account on the debit side. You are considering the whatever received, or Manohar's account, from Manohar's account is paying an amount of rupees 1,000. So this cash account is on the debit side, and Manohar's account is on the credit side. So received cash from Manohar on account. So whatever you are considering, you are having, or you are receiving cash from Manohar on account. So this is as per the personal account rule. So you have debit the receiver, credit the giver. So here Manohar is the giver, and your cash account is the, or the concerned cash account of Ajay is the debit account. So here cash account debit side, and you are doing debiting the receiver and crediting the giver. So it is represented like this. Now on 21st, interest on investment received. On 21st, interest on investment received. So interest received is actually an income. So whatever you are considering with respect to the nominal account, debit, expenses and losses, credit, income and gains. So received or interest on investment received means it is an income. So you need to write the interest account on the credit side and the amount cash account on the debit side. So 150 received as interest on investment, you need to represent that 150. The interest account you need to represent on the credit side and the cash account you need to represent on the debit side. Now on 25th, paid rent to the landlord. On 25th, paid rent to the landlord. So you are paying certain amount as rent. So this rent account is actually an expense. The paid rent to the landlord, which means you are paying certain amount, which means so it is an expense. So debit, expenses and losses, credit, income and gains. So here rent is an expense. So the rent account you need to write it on the debit side. Rent account DR you need to write. It is 550 on the debit side, and cash account that will be on the credit side. And you can write the description as the rent is paid or paid rent. And on 29th, Ajay has withdrawn cash rupees 500 for his personal use. So this kind of cash which is withdrawn by the firm, actually Ajay itself, which is we normally call it as the drawings. So you can consider Ajay has withdrawn rupees 500 for his personal use. So you can write that drawings as the debit side and cash account. You are considering cash account. So the receiver, credit the receiver and debit the giver. So here the drawings is actually in the side of the debit account, and cash that we consider is on the credit account. So here you have post withdrawal, cash withdrawal for domestic use by proprietor. So that is represented as the drawings. Now the last transaction is paid salary to the manager for the month August rupees 1000. So yeah, the owner is actually, or the firm is actually paying salary. So it is an expense. So debit expenses and losses and credit gains and income. So salary account is actually an expense. So salary account should be on the debit side and cash account should be on the credit side. So paid salary to the manager. Now, if you sum the debit side and the credit side amounts, you will get both the amounts as same amounts. If there occurs any difference between these two, that will be considered as an error in the process, and it will be accounted accordingly. So you'll have both the debit side and credit side amounts will be same once you account it properly. So this is with respect to the journal entry problem. Now you can consider what is called a ledger. So within the accounting cycle, first is your business transaction, then is your journal entry, and then you have something called the ledger entry. So a ledger is actually a collection or set of accounts. It is a book where transactions of similar nature, that is transaction relating to a particular person, item or service, are grouped together in one place in the form of an account, which means a ledger actually contains a number of accounts. A ledger will be containing a number of accounts. So for each account, you will be representing in this manner, which means you will be writing the name of the account. Left side will be the debit side, and right side you will be having the credit side. So you will be representing it as, you will have the date, you have particulars, then you are representing from the corresponding journal. You are representing, in case of journal, we represent it as LF, and here in this case you are representing it as journal JF, which is actually the corresponding transaction number in the journal that we consider. So from journal you are creating what is called the ledger. So name of account, it could be say purchase account, it could be sales account, it could be a personal account, it could be say as a expense account. So you are considering different types of accounts that are represented with respect to a journal, and each account you are representing separately all the accounts that we went across the journal, you are representing it separately as account by account. So this is basically called as what is called the ledger. So we are not going to details of ledger. We are not considering that how a ledger is prepared. It's a lengthy process. So what we are doing is, so this is the format that you need to follow. So a ledger is a book of transaction where you are considering, say, all the accounts of transactions. So as I mentioned as the definition, it is a collection or set of accounts. In the case of journal, it was a collection of all business transactions. Now, a ledger is a collection of set of accounts because we are considering each transaction from a journal, and by identifying the nature of transaction, whether it is an asset account transaction or whether it is an expense account transaction or whether it is a liability account transaction, depending on the nature of transaction, you are classifying different accounts and that account is actually represented. So you'll have, this is the format that is given. So you will be considering the name of the account. It could be a cash account or it could be a personal account of say a particular person. So and under that particular account, you will be representing what is called the debit side and the credit side. And under this, you will have the date particulars, the journal entry that is made. That number you will be representing here, considering whether the voucher number or bill number that is represented in the journal that will be represented over here, and the corresponding amount will be represented in the debit side and similarly in the credit side also. So this is basically called as what is called a, or what is a ledger. So you need to just study what is the definition of a ledger and what actually included with respect to a ledger. But you need to know how to represent a journal.